Hello, folks. Thanks for tuning in to TD Talks. I'm your host, Fiduciary Investment Advisor Taylor Davis. Today is Friday, January 16th, 2026, and today TD Talks Treasuries. I've seen a lot of headlines about this. I've had clients ask about it. What does it mean for the United States when foreign countries dump U.S. Treasuries, when they sell U.S. Treasuries? What does it mean? Now, I'll tell you this. I will preface today's market commentary with this. I have been a political commentator, an economic commentator on national news networks, regional, local. I'll tell you this, their goal, their focus is not to make you more informed. They do not make money by you being more informed. They make money by you watching. And what emotion do you think gets a viewer to draw in and stay on longer in viewership for that program? Fear, anger, but a lot of fear. Several times when I get a media request, hey, would you come on the show and talk about your opinion on this topic? Send us your talking points. I already know that they've reached out to me and several others. And what they're doing is evaluating what our talking points and opinion would be. They don't want to have two people who have the same opinion. Most time they want one person with one opinion and somebody with a completely contrarian opinion. And if your talking points are not entertaining enough for them, they're not bombastic enough, obnoxious enough, they love that. If they don't meet a criteria that they think is going to pull in a viewer and keep them on longer for that viewership, they'll go with somebody else because they don't make money by you being more informed. They do not make money when a poll shows the average viewer of this channel is more informed on financial and political topics. It's not how they make money. They make money by drawing in a viewer longer on that program so that they can turn around to the advertisers and increase that ad cost. That's how they make money. So I want to preface that with most of the time when you see a headline, it's either half the story and it's probably full of fear to draw in the viewer. So today on TD Talks, I'm going to talk treasuries. I'm going to get down to what it means when foreign countries dump U.S. treasuries. Now, at first glance, that headline can sound unsettling. It's supposed to, like I just told you, it's supposed to. But the reality is far more nuanced. Foreign governments hold U.S. treasuries. It's a part of their currency reserves. Those holdings rise and fall for many reasons. Some countries are selling treasuries to support their own currencies. Others are reallocating reserves to meet domestic funding needs. And then some others are trying to make a political statement. Oh, we're losing faith in the United States. Okay. This is not a coordinated vote of no confidence. It is a series of independent balance sheet decisions. Now, let's talk about what happens when treasuries are sold. When a foreign holder sells a treasury, that bond does not disappear. They don't drop it off in the desert and it's just gone. It simply changes hands. What the headline should say is foreign country sells treasuries and U.S. pension fund buys it. It simply changes hands. Another buyer steps in. Often that buyer is a U.S. institution, a pension fund, a bank, or the treasury itself. And this is where the treasury buyback discussion comes in. The U.S. Treasury has the ability to buy back outstanding debt as a part of normal debt management operations. This allows the Treasury to smooth market functioning, manage refinancing risks, and improve liquidity in certain parts of the bond market. From an economist's perspective, this is not unusual behavior. It is a tool used by large sovereign issuers. Now let's talk about the Treasury's balance sheet. When the Treasury buys back debt, when it buys it back, it alters the composition of outstanding obligations. It does not eliminate debt, but it can change the timing and structure. Think of it like refinancing a household mortgage. You're not eliminating what you owe. No matter what the YouTuber or the TikToker says, you're not eliminating what you owe. You're managing how and when you pay for it. Treasury Secretary Scott Bessent has emphasized this point in public commentary. He has stated that the U.S. Treasury market remains the deepest and most liquid market in the world. He's also stressed that maintaining smooth market functioning is essential to global financial stability. From that standpoint, Treasury buybacks are not emergency measures, they're maintenance tools. Now, let's address what this means for markets. If foreign selling were overwhelming demand, we would see disorderly moves in interest rates. That has not happened. Markets have remained functional. Auctions have continued to clear. Liquidity remains strong. Now, from a macro perspective, this suggests the sense that the system is adjusting, not breaking. So, what does this mean for U.S. investors? First of all, treasuries remain a core global asset. They're still widely used as collateral, as reserves, and as safe haven instruments. Secondly, changes in treasury ownership do not directly threaten stock markets or long-term investment portfolios. What they can do is create periods of volatility as market reprices, as the markets reprice their expectations of those bonds and the yields and the coupon. And volatility is not the same as risk. Volatility is movement. Risk is permanent loss. I'll say that again. Volatility is not risk. Those are not interchangeable terms. Volatility is movement. Risk is permanent loss. For long-term investors, the key takeaway is global capital flows are evolving. Debt management is becoming more active, and policy coordination matters more than the headline suggests. This reinforces the importance of diversification across asset types and time horizons. It also reinforces the danger of reacting emotionally to complex macro stories. So, in my opinion, this is a moment for perspective, not panic. The Treasury market is adapting. That's what I'm saying. The Treasury market is just adapting. The US government is managing scale, and investors should stay focused on long-term fundamentals. It's what I'm staying focused on. I'm focused on long-term fundamentals. This is not a signal to abandon strategy. It is a reminder that large systems require active management. And when you look at, overall portfolio performance, if US Treasuries fell in value, your portfolio is not crushed if you don't own those treasuries. If you're a long-term investor, younger investor investing for the long term, in my opinion, your focus is beating inflation, not safety. And historically, thinking in terms of my thought process of looking at asset management, the only way to consistently have a high probability of outpacing inflation is through equities, not treasuries. So if you're not holding a bunch of treasuries, if you don't have a large allocation of treasuries, every headline about US treasuries, if you're not a holder of it, should not affect you emotionally at all. In fact, it should refocus you on the long-term plan. That's it for today's TD Talks market commentary here today, TD Talks Treasuries. Thanks for tuning in. You can subscribe on YouTube, Apple Podcasts, and Spotify. See y'all soon.